Let's now solve question number 1, which is a case-based scenario question from our Jan 2025 RTP. Interesting one and not a very difficult one. Fatapat read the question. Surya Limited has two fixed assets, FA1, FA2. Balance sheet value of FA1 is 600 lakhs and balance sheet value of FA2 is 300 lakhs. Basically, this is carrying amount. What is this amount? Let's make a note of this data, whatever they've given, before we forget. I would write here carrying amount, which is balance sheet value of FA1 is 600 lakhs, FA2 is 300 lakhs. What is after that? On 31st of March 2024, value in use of FA1 is 500 lakhs. If you remember, to check whether an asset is impaired or not, we need to compare our carrying amount with recoverable amount. If carrying amount is more than recoverable amount, asset is impaired. If the carrying amount is less than recoverable amount, asset is not impaired. Recoverable amount is higher of two things. One, value in use. Two, net selling price. Value in use is present value of the future cash flows arising from utilizing the asset. NSP is net selling price on sale of the asset as of today. Net selling price is expected selling price minus selling expense. They're telling value in use for FA1 500, net selling price 550. Value in use 500 and net selling price 550. You tell me, recoverable amount is higher of this, which is 550. 600 is the carrying amount of the asset. If its recoverable amount is 550, we are going to incur impairment loss of how much? Why is there impairment loss? This is because the carrying amount is greater than recoverable amount. Impairment loss will become 50. What do we do with this 50? Usually we deduct it from the cost of the asset and also transfer it to P&L. However, if there is goodwill against this asset, which can be allocated on reasonable consistent basis, before deducting from the carrying amount of the asset, we deduct from goodwill. Beyond goodwill, if there is excess of impairment loss, that will be deducted from the cost. And this impairment loss has to be transferred to P&L. Usually it will be transferred to P&L. However, against the same asset, if there is any revaluation reserve, before we transfer to P&L, we'll adjust it against revaluation reserve. In excess of revaluation reserve, if there is any amount, such amount will be transferred to P&L. Everyone got this? Yes. Let's read this question further. The company did upward revaluation last year for the amount of 20 lakhs. Unless they mentioned, we will never assume that 20 lakhs is proportionately transferred to PL. That is excess depreciation. We will never assume that it is done unless they mention. So this entire 20 lakh is assumed to be remaining in revaluation reserve. We made impairment loss of 50. Am I right? If they would have not spoken anything about this upward revaluation, I would have done complete 50 transfer to PL. Because they have done revaluation last year and there is revaluation reserve available to the extent of 20, out of this 50 lakhs of impairment loss, 20 lakhs will be adjusted against revaluation reserve. Excess of 30 will be taken to PL. Everyone got this? Then the next part of information in the question says, as at 31st March 2024, value in use for FA2 is 350 and net selling price is 320. Value in use 350, net selling price 320. Whichever is higher. Very good. When you test for impairment, observation is carrying amount is lesser than recoverable amount. There is no problem with FA2. You are not impaired. There is no impairment loss on FA2. Should you book any impairment loss? No impairment loss. That's the end of the question. They've asked couple of questions. Sorry, 4 questions. First one, how much is the total impairment loss for the current year? Total impairment loss is only on the FA1. FA2, there is no impairment loss. 50 lakhs, which is option 2. Then, second one, how much impairment loss will be charged to P&L account for the current year for FA1? See, out of 50 lakhs, 20 lakh will go to revaluation reserve. Charge to P&L is 30 lakhs, which is option 3. See, option 3 which says 30 lakhs. Sorry. Option 3 which says 30 lakhs. Understood this? Let's see question C. How much is the total impairment loss for the current year for FA2? Option 4, nil. Why? It has failed that test. Basically, what has happened is carrying amount is lesser than recoverable amount. Impairment loss will come only when carrying amount is more than recoverable amount. So there is no impairment loss. Lastly, we have one question which says, what will be the carrying value on 1st April 2024 for FA1? carrying value for 1st of April 2024 for the asset is its original cost was 600. Now we are going to book impairment loss of 50. There is no goodwill. If there was goodwill, I would have adjusted that impairment loss against goodwill before adjusting against asset. Here there is no goodwill allocable on reasonable consistent basis. So entire impairment loss of 50 will be deducted from original cost of 600 or carrying amount of 600. Recoverable amount will become the carrying amount of FA1, which will be 600 minus 50, which is equal to this 50, which is 550. This, my friends, is the answer for question D. We have one more question, which is a multiple choice question. This is from Accounting Standard 11. The debit or credit balance of foreign currency monetary item translation difference account. Where are you going to show? This, if you remember, is para 46A of Accounting Standard 11. Whenever there is exchange difference arising, because of which the company's profit is going to turn into loss, then there is a special provision, option given by MCA, Ministry for Corporate Affairs, which says, unlike usual case where we translate the foreign currency to domestic currency and transfer the entire difference to P&L, what do we do? The option under 46A is don't transfer to P&L. Add it to the cost of the asset, which will be later depreciated. But if you don't have any asset against which you can add, then 46A says you can transfer it to an account called foreign currency monetary item translation difference account. Quick MIT DA. This amount will remain not on the asset side of balance sheet. There is no space. It has to be written in reserves and surplus, and over that loan period, it will be transferred to P&L account. That's it.